Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen. Today, we've got a fascinating topic to dive into. Are Canadian mortgage rates about to plummet? This question has been on the minds of many homeowners and potential buyers, and we're here to give you the insights you need. Just recently, the United States Federal Reserve slashed interest rates for the first time in 4 years. This move has sent ripples through the financial markets, and it's important to understand how it could impact us here in Canada. At the same time, Canada's inflation rate has reached the Bank of Canada's 2% target, which is another key factor in the equation. Now, you might be wondering why these events are significant. To break it down, when the United States Federal Reserve cuts interest rates, it often influences other central banks around the world, including the Bank of Canada. Lower interest rates in the United States can lead to a stronger Canadian dollar, making Canadian exports more expensive and potentially slowing down our economy. In response, the Bank of Canada might consider cutting rates to keep our economy competitive. But it's not just about what the United States Federal Reserve does. Canada's own economic indicators are also playing a crucial role. With our inflation rate hitting the Bank of Canada's 2% target, economists are predicting that more aggressive rate cuts could be on the horizon. This is because the Bank of Canada aims to keep inflation within a target range, and if inflation is at the lower end of that range, they have more room to cut rates without risking runaway inflation. So, what does all this mean for Canadian mortgage rates? Well, if the Bank of Canada decides to cut rates, we could see a significant decrease in mortgage rates. This would be welcome news for anyone looking to buy a home or refinance their mortgage. Lower mortgage rates mean lower monthly payments, which can make homeownership more affordable and potentially stimulate the housing market. However, it's important to note that while rate cuts could lead to lower mortgage rates, they're not guaranteed. The Bank of Canada will carefully consider a variety of factors before making any decisions. These include not just inflation and economic growth, but also global economic conditions and financial stability. In summary, the recent interest rate cut by the United States Federal Reserve and Canada's inflation rate reaching the Bank of Canada's target are prompting economists to predict potential rate cuts here in Canada. If these predictions come true, we could see lower mortgage rates, which would be beneficial for homeowners and buyers alike. As always, we'll keep you updated on any developments in this area. Welcome back, listeners, to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen, and today we're diving into our weekend reading segment. Are new mortgage rules helpful? The big news in the mortgage and home buying world lately is that our federal government has introduced 30-year amortization periods for all first-time home buyers and all buyers of new builds, regardless of whether it is their first home. This new rule extends beyond the longer amortization period that recently only applied to first-time home buyers of new builds, including condominiums. Additionally, effective December 15, 2024, mortgage insurance qualification has increased to cover houses that cost more than $1 million, up to $1.5 million. The aim here is to address the massive housing shortage in Canada, which has triggered an affordability crisis driven by supply and demand. So, will these changes work? Why were they made? Well, as younger buyers attempt to get into the housing market versus renting, the government wants to extend the amortization period you can take, which essentially means taking out more debt to own a home over a longer period of time. In major cities like Toronto and Vancouver, where the cost of an average home is now valued at over $1 million, one could argue extending mortgage lending terms is an easy win. But there are significant impacts to consider. For buyers, with interest rates coming down and likely more so in 2025, these new rules mean paying for a house will be stretched across more years, reducing the monthly cost. This helps better manage your cash flow and mortgage payment. Additionally, the new cap on the value of homes that qualify for insurance means anyone buying a home that costs between $1 million and $1.5 million will no longer need a sizable 20% down payment. In terms of buyers who are investors in real estate, we might not see a big shift with these changes, but it's possible since speculators may consider capitalizing on existing equity to buy up more property. For lenders and banks, there will be a shift in risk management between the lenders and insurers that are backstopped by the government. More mortgages are going to be purchased in higher value up to the new mortgage insurance qualification threshold, which means our government is going to carry more of the housing risk. Recall, Canada Mortgage and Housing Corporation, or CMHC, is a Canadian Crown corporation that serves as the National Housing Agency of Canada. The goal of this agency is to make mortgage loans affordable for all Canadians through a housing development strategy and mortgage insurance, among other initiatives. As credit risks may come down for Canadian banks, you might want to consider what impacts that might have on their stock price. More mortgages mean more interest payments from borrowers and potentially more profit for the banks. For the real estate market, I predict more and higher home sales. These changes, along with lower rates coming down into 2025, are going to drive more folks into the existing pricey housing market and drive scarce homes even higher in price. Existing rules and recent interest rates have been a natural barrier to entry, and the government is trying to knock down those walls. In summary, these new mortgage rules are designed to help first-time homebuyers and buyers of new builds by extending the amortization period and increasing the mortgage insurance qualification cap. While these changes aim to make homeownership more accessible, they also come with significant impacts for buyers, lenders, and the real estate market. It's a complex issue, and only time will tell if these rules will genuinely be helpful. That's it for today's episode. Thanks for tuning into the Ontario Mortgage and Real Estate Insights podcast. I'm Steve Hamwin, and I'll catch you next time with more insights and updates. Have a great day.